Why do you think this trade war is happening?
This is about global power. America knows that it's losing power in the world and China is gaining power. If they don't play their hand now, while they still got some power, it's going to be curtains. Markets don't like uncertainty. It doesn't matter what it is. What this does is it gives us opportunity to buy, opportunity to get really good prices.
But why should people bother investing?
Your money is under attack. We're getting into an era where S&P 500 is not enough. I think it's the starting point. As a long-term investor, you don't need to be someone that just buys and holds. That's old. That doesn't do it anymore. Not in your ISA. Investing is a game of good decisions.
Yeah.
And a good decision can lose you money, and a bad decision can make you money.
True. Yeah.
But the key thing is if you constantly keep making good decisions over and over and over again, your portfolio will do what mine did.
You're not defined by where you come from.
Yeah.
And I think that's a big message that I always want to tell people. Like
you have to be able to be uncomfortable.
Yeah.
Like be comfortable with being uncomfortable.
When you grow up in ends, you don't realise it when you're confident, but you have an audacity to do things that ordinarily most people wouldn't be willing to do.
Welcome back to another episode of the podcast. I'm your host, Atto. We have a special guest in the building, a repeat guest. Actually, I think you were my second episode, man. It's been a long time, Debodun. How are you doing, bro?
I'm good.
Debodun is a former trader at Goldman Sachs, founder of Stockpickers Academy, a community that educates you on investing in the stock market, founder of Coach Tube that helps you prepare for job interviews. He's an investing coach and angel investor. Like I said, it's been a long time, bro. How are you?
I remember when you had the old version.
I think I was like, I think
Now
it was
we
a
got
spaceship.
production.
That is what it's about, man. That's what happens when I feel like you put in the work and you kind of stay patient and you just keep on like grafting and you just try and keep on providing value. And I think that you'll kind of get somewhere. And I think the same things happen with you because your page, I think your page is definitely older than mine. And you've been doing what you've been doing for a long time.
Yeah.
And I think now finally you're getting like the recognition you deserve, especially like when it comes to like investing. I don't know if you feel like that, but I feel like that.
Do you know what it is? I feel like I've been getting it behind the scenes, in person, DMs, on WhatsApp.
Yeah.
But social media is interesting where eventually to tap into completely brand new audiences, numbers start to matter.
Yeah.
Followership starts to matter. And yeah, it's been an interesting trajectory, you know, growing my followers, finding new audiences, finding people that haven't heard about me before. And there's still so much more to go. Yeah,
for sure, man. Like, especially with what's happening now. So obviously I described a little bit about you and I would say to people, definitely go and watch that episode as well, because Debodun shares a lot of his story in that. And I think it was a very great episode. But can you tell the people a little bit about yourself and your journey?
Yeah, so my name is Debodun Osekita, aka Coach Debs, your investing coach, your personal trainer for money. Life began in Peckham. I was born in 1989. I lived on the North Peckham estate, which was notorious.
Yes.
Yeah, from crime to infestation of cockroaches to just filth sometimes. It wasn't the best environment to grow up in, but I didn't notice it. I had the best childhood. And when you're living in there and that's all you know, and you don't really know how other people are living, you don't really see it as struggle.
Yeah.
I had a very loving family. I have 2 brothers, 2 parents, still together. And I think this does make a big difference in, you know, making sure, because I could have gone on a different path very easily.
Yeah.
I mean, anyone that knows me in primary school, sometimes I bump into people I knew at primary school and they can't kind of believe it because I was a kid always getting kicked out of lessons. And even though I was very intelligent, there was some trouble in there, right? But if it wasn't for my family keeping me grounded, ensuring I didn't get past, trouble is a spectrum.
Yeah.
There's in-school trouble and then there's on-the-road trouble.
Yeah, it's two different things. Yeah.
And I think I was intelligent enough to know where not to cross the line. But at the same time, if my parents hadn't been there, if I wasn't in a complete family, I can't say for sure that I wouldn't have ended up on a different trajectory completely.
Yeah, well, thank God that did happen, right? Because like, look at what it is now. It's like it's like, it's a good trajectory. So you worked at Goldman Sachs, which is crazy. It's a massive achievement, right? And we talk a little bit about that, which is why I'm saying to people, definitely go and watch that episode, because we talk about how Debodun got into Goldman Sachs. So you worked as a trader there, right? In that time working there, right? And obviously now post that, you've been investing in the stock market for years. What kind of key insights do you kind of pick up on? Was there any kind of aha moments for you that you kind of saw?
Yeah, so I was there during the peripheral crisis. Do you remember the pigs? Portugal, Italy, Ireland, Greece, Spain. And I was also interning at Barclays in 2008, just after Lehman went down. So I actually joined the industry at a very, very critical time where a lot was going on, and there were just bombs everywhere when it comes to the markets. I'm a mathematician. I studied maths at Warwick. But the key thing I'd say I picked up from Goldman was actually how to think about investing, how to think about risk, networking, how to connect with people, the importance of connecting with other people that you can just pick up the phone and say, I'm looking to invest in this. What are your thoughts on the industry? What's your thoughts on what's going on with tariffs? So getting a trading job is quite difficult. They put you through it. If you think about apprentice, but then just think markets. So at interview, you're getting tested. What's 99 squared and harder questions as well. You're getting tested on giving a trade idea. You need to be able to come up with an idea or a view on the markets. And I think one of the biggest things I got out of the whole process of landing a trading job was I got to a point where you could ask me anything about markets and I'd have an opinion. It doesn't matter if the opinion is right or wrong, but the fact that you can put ideas together, research together, your own input, and to come up with an opinion is like something I still do to this day. And I think that's one of the most, I get my edge through that because my opinion is a function of my network's opinion. And then my own opinion on it. Right. And if you don't have a network, if you don't have people you can trust and, pick their brains, even if you disagree, at least you know that that's their thought process. Then you're going to struggle to invest, especially when it comes to your own personal funds.
That's a very interesting thing that you're talking about, a network, because obviously you've got a community where a lot of people are sharing ideas, talking about the markets, right? And I like the fact that you said as well about, being able to think and give an opinion, because even now, I feel like, I don't know if you feel like this, but now more than ever, the world is so fast changing, things are moving. We're going to be talking about the tariffs now, right? And even that, having a perspective on that is very interesting as well, because it does impact like people's investments. Like, I know we were talking about it offline and we'll talk about it more deeply as well, but I'm sure people have been calling and saying, what do I do with my investments? What do I do? Do I sell? Do I buy? Like, I know people are probably panicking. I even, like, somebody asked me, like a financial advisor I speak to, like, how do I feel about it? And my response was, I'm not gonna lie, I don't have no feeling about it. I'm just so like, okay, sure.
You trade what you see, not what you think you see.
Right?
I'm very reactionary in the way I invest. I let what's going to happen. And I just have a framework and a strategy that I'm just going to stick to no matter what. And what happens is always going to happen. It might work in your favor, it might not work in your favor. But the key thing is I've got a strategy that I've been using for the past 10 years to grow my funds. The importance of community. And when I was building Stock Pickers Academy, I realized that if I was to teach the average person how to invest in the stock market, they need a community. They need access to my personal network. I'm a networker. So, you know, there are people that were partners at Goldman Sachs then and left and are partners now, and they watch my WhatsApp stories. They watch my, Instagram stories, even though they're not even really that active on Instagram. You know, they're very, very invested in what I'm doing now. And if I didn't build those relationships, then they're lost in that world and I'm lost in my world after leaving. So I've been able to maintain a lot of good relationships, not just at Goldman Sachs, everywhere I've worked, right? I've got a lot of my old bosses or work colleagues in the WhatsApp group, right? So when people ask a question, it's not just me, the expert. It's you're asking your tribe. You're asking a whole range of experts in that group. Some of them are currently in the markets right now. And the questions are not, what should I buy? What should I sell? It's how should I think about this? What does this mean? You know, and just having people that can just answer those questions in their way is very, very valuable. Yeah. And it's very, very difficult to get certain type of people in a WhatsApp group.
100%.
Especially people who are not WhatsApp group chat people. Yeah. So that was my biggest win, to get people I knew don't do WhatsApp groups to stay in that group, to contribute in that group, and to also benefit from that group.
And it's a very active group, honestly. It's a very active, and it's valuable. It's very valuable. So I wanted to talk about, you know, the basics of investing, because I think it's important just to repeat to people, right? So, you know, if we're breaking it down, when people are investing, when people say they invest in the stock market, what does that actually kind of mean?
Well, a company is a stock. A stock is a company. It's just a business. And when you buy a share of that business, that's what you're doing when you invest. You're owning a share of that business. Many people look at the stock market like it's some sort of casino. It's not. It's a marketplace where, just like on Amazon, you might go and buy a pair of flip-flops. You can go have access to the stock market, to the stock exchange via a platform like Hargreaves Lansdown or Trading 212. And what you're doing is you're buying a piece of an already existing company. So yeah, that's stocks investing in a nutshell. And businesses can go through ups and they can go through downs. And sometimes that will be reflected in the stock market and sometimes it won't. There are businesses that are struggling that can double in price. There are businesses that are fantastic that can fall 50%.
And it's true.
We've seen it.
We've seen it a lot. I'm not going to mention any, but we've seen it in a lot. And then if people are wondering, why should they bother investing? Because I think that's some of the questions I kind of battle with people. They're thinking, nah, it's not for me. But why should people bother investing?
First of all, you need to understand your why. Inflation, our money is under attack. Your money is under attack. Inflation is the measure of how quickly outside is getting more expensive. The things you spend money on are getting expensive. So if you're not growing your savings, a lot of people leave 6 figures, 7 figures in their current account, earning 1%. Some other people move it to their savings account, earning maybe 4% now. And then there's passive investing in the stock market. And everyone talks about the S&P 500 and investing in an index fund. And there you're able to average about 10%, which basically means £100 a month over a 25-year period into the S&P 500, which is supposed to yield you approximately 10%. It's going to get you maybe 125k, roughly. Tax-free, effortless, hands-free. So I think that's then the next stage. But we're getting into an era where that S&P 500 is not enough. It's not enough. I think it's the starting point. You have to constantly, and the Americans are so good at this, you have to constantly think, what's next? Crypto, individual stocks, angel investing. This is where real wealth is built.
Yeah.
Right? And a lot of people just stop at the S&P 500 and it's lazy. I get it. You're busy and you're lazy, and they've said that if you do that, to be fair, there's a lot of people not actually investing in the S&P 500, and that's actually even a bigger problem. But for those that have, and you've been doing it for 5-6 years, you should be getting to that point where you want to pick one stock. It doesn't need to be a massive stocks portfolio. You can literally look at Meta at my buy alert price. So I've got the watch list that has like indicative, cautious entry levels, very, very deep discounted prices, right? So let's say Meta was at 350. I would set a price at 100 and say, listen, I'm not going to buy Meta unless it hits that price. And when I do buy it at that price, I'm not going to spend, I'm going to fix a budget. And even that fixed budget, I'm not going to spend it all at once.
Yeah.
I might spend a specific percentage of it, and I'd spend another percentage of it if it hit another specific price. So what my model does is it gets those prices that I would break down my budget into spending.
Okay.
Right. So that is the Spartan way of investing in the stock market. It's very cautious. It's very careful. And it's not go and buy this at this price. It's if you are going to buy this, because what's happened is there are a lot of people who have gone into the stock picking world, the crypto picking world, and are doing it anyway. And they've got 6-figure portfolios, 7-figure portfolios, 5-figure portfolios, and they're doing it with no strategy. They're making silly mistakes, and they're doing it with just no guidance. So these people need something. They need someone to say, listen, that's too risky. You've got your sizing wrong. Based on how much you've got in the S&P 500, you should only be using this amount for crypto and this amount for stocks. Anything more, you're exposing yourself to too much risk.
Yeah.
Someone to have these kind of conversations with them. And that's what an investing coach does, as well as educating them on those types of investment, so that they listen. I can't put a gun to your head and say, don't pick stocks, don't pick crypto, don't do this risky stuff. But what I can do is I say, if you are going to do it, here's my safest way, cautious way of doing it with the strategy that I've created.
Yeah. Yeah. It's interesting that you said that, a few things. You said that obviously there's some people, 1%, which is true. Some people are not even really like looking at their money and even trying to put it into, if we're talking about emergency funds, into like a 4%. And then you mentioned investing. A lot of people in the UK still don't even invest. The rate, anyway, from the stocks and shares point of view, is a low take up. It's only, I think I've said this before, about 6%, 6%. It's under 10%.
I mean, in 2019, it was 3%.
Okay, so it's doubled. That's good. So we're making progress, but it's still...
It's not good enough.
It's not good enough.
I blame the government.
Yeah.
The UK is not... The environment in the UK is not very conducive to someone that wants to build wealth as an entrepreneur, as an investor in the stock market, in crypto. Like, it's just very, let me tax what you have and what you're making, rather than actually... Let me make sure you've got the right education, financial literacy. Let me make sure that you understand the different asset classes and how you can make money in them. And then let me make sure that you're very business savvy. You understand what it takes to be an entrepreneur, how to start your own business if you decided to, how to pay taxes, how to do all of this kind of stuff. If you do that, and people are able to generate wealth, either as an entrepreneur or through their investing, that tax, without changing the tax level, the tax revenue is going to be much higher.
Yeah.
Right. And that's the approach that the Americans take. And we need to switch this up in the UK. It's just not good enough.
I agree. I have this conversation a lot, and it's just, in America, it's just, like you say, it's just in terms of innovation, they're just more interested in innovation, more interested in business, more interested in investing. It's normal to have investing conversations there, whereas here it's like, no, why are we talking about that? What are we doing that for? We've all experienced buyer's remorse, spending money on something and instantly wishing you could take it back. Leaving your business funds in a regular current account is just like that regretful purchase. It's a missed opportunity. The money's sitting there doing nothing when it could be earning interest and working for you. There's so many ways to grow a business, and using a high interest savings account is one of the lowest effort wins you can get. With rising business expenses like staff costs, travel, marketing, and software subscriptions, why not let your business savings do some of the heavy lifting? So I made the switch to Tide's instant savings account, which earns me up to 4.48% AER variable on my business savings automatically, no extra admin required. The more you save, the higher the rate. So my money's always working at its best. I can access my business funds instantly with no withdrawal fees, and you don't even have to bank with Tide to use it. You can open an account with just £1 and it's FSCS protected up to £85,000. And because I know how valuable this could be for my community, I've partnered with Tide to bring you an exclusive offer. Get a £100 bonus when you open and fund a Tide's instant savings account with £5,000 within the first 30 days and use my code SavvyWallet. Plus, for the first 6 months, new members can earn up to 4.48% AER variable on their business savings. Setting up your Tide instant savings account takes just 3 simple steps. Tap the link in the episode description, enter the code SavvyWallet, and start putting your money to work. New Tide members receive up to 4.48% AER variable on balances over £1 million, free for 6 months. Then your Tide's planned savings rate and thresholds apply. For the full offer, T's and C's, visit tide.co/savings. Rate correct as of the 15th of April 2025. So on that note, right, people that you've spoken to, what have they kind of told you about their fears of like even trying to get into investing in the stock market?
It's interesting. I've got a mix. I've got people that actually work in a city in stocks research and are scared. They've got imposter syndrome when it comes to managing their money. And they're telling me that it's only because they joined my group that they felt confident to even give it a go. And then I've got people who have misconceptions. You've got all these myths flying around. Like you need X amount to make money in stocks. You can literally put £50 a month into an index fund and it will grow at a rate of 10%. Yeah, I think the biggest obstacle also with women, I think I read a stat that, I can't remember the exact percentage, but there's a stat that said that most women feel financially confident, but then don't invest. The percentage of women with stocks and shares ISAs, I think was something like 16%. But then the percentage of women who felt confident with their money was something like 69%.
Okay.
So it's like, okay, so you feel financially confident, but you're not investing.
Yeah.
So
it's interesting.
Literacy is a big one. If you don't know how to start, if you don't know how to buy a stock, if you don't even, if you've not seen the numbers of what you can do with the S&P 500, then you're not going to get started and you're just going to be stuck with all these preconceived ideas. So that's definitely been a barrier to entry. Imposter syndrome. Some people don't feel like they deserve to be wealthy. Like, look in the mirror and tell yourself, I deserve to be wealthy. I deserve to be rich. I deserve to be financially confident. When you can say these things, you'll start to believe it.
Yeah.
But some people feel, let me give you an example. There are a lot of people who probably could afford a Ferrari or a Rolex watch.
Okay.
And they just wouldn't ever get it because they feel uncomfortable about how they could be perceived by others when they pull up that Ferrari back home, right?
Yeah.
And because of that, they just don't go out to get it. They don't feel like...
I know what you mean, yeah.
There's an imposter syndrome, right? It's not always humility. I think we always think that is this person's being humble. Actually, this person's scared to buy something flashy and for other people to see it. You still need a little kind of heart to pull off some of this stuff.
100%. You need the
okay.
heart.
So there are some people who are like this with getting financial advisors. They think, oh, those guys in the suit and tie, have I achieved that level of wealth to be entitled to even go and get a financial advisor? How would my friends think if I told them that I've got a financial advisor?
Yeah.
How would my friends think? What would my friends think if I told them I've got a private banker, a wealth manager? You know, it's that same thing.
Yeah.
The Ferrari is the financial advisor, because now you're telling, it's a bit like telling people you've got a private chef,
Yeah.
right? You're going to pick and choose who you tell people, who you tell, or a butler or a cleaner. Financial advisor, because these are measures of you hitting a new financial milestone that requires these things. And a lot of people actually don't go and get that advice because they feel imposter syndrome around it.
Yeah, it's true though. I think it's definitely true. Like, I think the fear of failure, the fear of, like you're saying, you don't want to. It's just like here, right? I think it's because we don't talk about money.
Yeah,
is like, and we don't like what we were saying before, the whole innovation, lack of business, lack of investing. It's just that if you do talk about that, you're like, you think people are going to look at you some way like, oh, is that like, nah, like, what are you talking about? You're not allowed to be getting further. You should just be here, just be quiet, play small, and that's what it is. And if you're not, you're arrogant, you're this, you're that, and you don't want to come across like that, right? It's very interesting.
But there's one thing I do notice: people aren't afraid to tell everyone. It's the keys.
That's the only thing that
They
people
don't
are
mind
not.
showing
The
keys.
poppy. They're not. Yeah, nobody. It's true, actually. It's true.
But no one goes around saying, "I've got a stocks and shares ISA and I'm hitting."
No one does. No.
I've got a. You know.
Yeah. It's an obsession, isn't it? The keys is the biggest obsession that we definitely have here in the UK. It's like, that's like, for some people, makes them feel like they've achieved the ultimate goal. Yeah. You know, it's mad. I guess we're just comfortable with property more in the UK than with stocks.
With stocks.
Which shows, dare I say it, it's an old style mentality, isn't it?
But I understand
in a weird way, right?
I understand it because property has been part of wealth for centuries, millenniums, right? Whereas stocks is a new thing.
Yeah.
Right? People, even running a business has been around for as long as you can think of. So being an entrepreneur, being a property owner, buying land, buying a house or building a house, these are things that go back to the beginning of time.
That's
so
true.
I think I can understand why people trust it and have that confidence in it, you know, bricks and mortar. Whereas the stock market is something that the Americans came up with, and it's just evolved over time into what it is today.
Yeah, it's mad. So do you feel like, I know you mentioned S&P 500, you mentioned like global index funds. Do you think anybody, regardless of like their experience level, should have that as part of their portfolio?
What, the S&P 500?
S&P 500 and global index funds as well, yeah.
I'm not a fan of global index funds.
Is it? Okay, talk to me. Why not?
Because I've looked at them and I understand them. And a lot of people just go online and they regurgitate stuff that they've heard. And there's a lot of people that talk about the S&P 500 that I can ask them 10 questions and they'll get stuck. Right? How many stocks are in the S&P 500? Is it 500? Or is it 502?
Okay.
Right? How often does the rebalance happen? I can grill people. What is the forward price over earnings ratio? At the moment, it's 23 times. And I actually made a big call in my group, as you know, that above 6,000, we need to be selling the S&P 500.
Okay.
Complete liquidation.
Okay.
My biggest clients, the 7-figure, 6-figure clients, I called them up. It's time to sell. And they looked at me like, what? So the S&P 500 has something called a forward price over earnings ratio. And at the moment, it's 23 times. And in history, if you look at the decade of returns on the S&P 500, when it's hit this level, it's average close to zero.
Okay.
The decade where that's where it's at. If you look at the charts, I look at candlesticks, I look at technical analysis, I look at a few different things as well. Monthly candles were showing that it's time to take profit, liquidate, sit on your hands for a year, just watch what happens in markets. Something isn't quite right. So yeah, they sold.
Okay.
They asked me if they're going to get back in, what level should they be getting back in at? And I said anything between 5,000 and 5,500. So most of them bought in the past week.
Okay. Wow.
Rebought back in. Now, these are the optimizations that will help you outperform the S&P's 10% a year.
Okay. That's interesting. So let's talk a little bit
And I've
about
done
that.
this like 6 times over the past decade.
Okay.
Yeah.
That's
There's
so
been some
interesting.
specific levels.
Yeah.
Different reasoning though. This
Yeah.
is the first time I've seen 23 times forward price over earnings ratio. But then I also realized that a month after I made a call, Warren Buffett did the same thing.
Okay.
So that was a good, nice confirmation. Because sometimes when you make these calls, you need someone else to do it as well to know that you're sane. He did it. And then I was like, yes.
Okay. Interesting.
He's looking at the same data. He must have seen something I've seen as well.
Yeah.
Or maybe he's got like a spy in my group.
You never know. You never know.
Yeah.
So no, go ahead. Sorry.
Yeah, I think you should. I think you should definitely own S&P 500. I don't own any myself because I'm a stock picker. I'm creating my own S&P
500. Yeah.
10 or 20 or 5, my own portfolio of stocks. But if you're not in a group like this where you got access to experts and a watch list and a coach, just stick to S&P 500. With the global index funds, you have to remember that global index funds is almost like 70% S&P 500, 30% emerging markets. Emerging markets are higher risk. They're just higher risk by definition, right? Because they're emerging markets. So what you've done is you've added risk to the S&P 500. And I believe by doing that, your global index fund is on paper more risky than your S&P 500.
Okay.
Now let's look at the returns. Because if you take more risk, what should you expect? You should expect more returns, right? S&P 500 and let's say your MSCI global index, they're roughly the same. I mean, arguably S&P 500 is even outperforming it in the long run. So if you're getting similar returns, but you're taking on more risk, why? It's not for the individual investor. It's for the institutions. These products were designed for institutions to diversify, but also to hedge. If you're a trader in an investment bank and you have an emerging markets book and you're market making, and by market making, I mean you are William Hill, right? For hedge funds to come, for Warren, you are taking the other side to Warren Buffett's trades, Ray Dalio's trades, George Soros's trades. You have to have products that you can use to hedge.
Yeah.
And by hedge, I mean protect yourself. And that's what these indices are actually really used for.
Okay.
Right? Unless there's someone, a hedge fund, taking a outright view on global markets, then they will express it by going long, which means buying, or going short, which means selling. But you can actually buy a stock and then sell S&P 500 against it. So it helps you take more of a measured view on the individual stock, isolate the risk. And you could do the same for emerging market sectors and stocks. So you could buy EM industrials or EM banks, and then you can sell MSCI Global against it, and you hold it as a combined position. So it helps you isolate that. So if you understand the use of global index funds and even index funds, I keep saying index funds. I should just say indices, right? Then you understand that I personally do not believe global index funds really should be used by individual investors unless that individual investor has done the analysis I've done and said, actually, I'm okay with this extra risk. And I genuinely believe at some point in the future, they will start outperforming the S&P. But the data doesn't support that so far.
Okay. Interesting.
So why,
see that.
right. So why, if I sit down and grill an individual investor on why they've got a global index fund as opposed to S&P 500, they can't give me an answer. So then they shouldn't be in it. If you can give me an answer and I say, okay, fair enough. Because there's nothing wrong with taking that view. There's something wrong with just buying it because you've read some influencer online say that you get access to stocks from all around the world and you're diversified. Diversification actually it's overrated.
Okay. Interesting.
Right? The more diversified your portfolio gets, right, eventually you might as well just have an index fund. Diversification kills returns. And that's okay. But you need to know that it kills returns. It gives you lower risk, but it also gives you low returns.
Yeah.
And that's the argument for picking stocks as well, alongside. Okay. So you've got an element of your portfolio that enables you to benefit from medium risk, higher return. Sometimes you would get opportunities like Meta, which did 7x from 100 to 700. Low risk, high return.
Yeah. Yeah, Metal's historical, for sure. Metal's historical. I've got a few follow-up questions to ask you, right? Because the S&P 500, the argument people say, well, it's America. So are you kind of saying you're almost betting and believe that America is still going to be able to provide those returns?
I've got this phrase, right? And I've seen China. I've seen the Chinese indices. I used to trade Asian stocks, right? China, Hong Kong, Singapore, Taiwan, Korea. I've traded these stocks. I know how they behave. India as well. They're not there yet. They're still emerging markets and they can be very choppy. You only need to go back to a few years ago when China came out and said, you're not allowed to be a billionaire from EdTech. All the stocks related to that just went.
Yeah.
America's invented the stock market. America's the leader of the free world. And as long as that continues to be the case, if America sneezes, as I always say, the whole world catches a cold.
Okay. So,
right? When S&P 500 drops on big macro news, all the other indices follow.
Yeah.
It's just how it is. There's a hierarchy.
Okay. Fair. And the hierarchy is the S&P 500. The hierarchy is okay, fine. Okay, cool. No, thanks for sharing that, because I do always like to ask this, the S&P 500 versus global index funds, and it's interesting that that's the perspective that you have, especially that you're in the markets day in, day out. Like you know, so having that perspective is not a perspective that's been shared. So it's very, very...
I mean, I used to market make both.
Yeah.
At a point,
did you?
Yeah.
Okay.
Yeah.
Okay, so then you have an in-depth understanding, understanding of it. So when do you think it's, in terms of feeling confident? Because obviously, again, like there's levels to it, right? People are not even investing, but let's say there are somebody listening, they've now started to invest. When's the time for them to start feeling confident to be like, okay, now I can start dabbling in individual companies, investing in, individual stocks?
I think it's I like the analogy of driving. When you learn to drive, you pay £1,000 to learn. You got your driving instructor, and then eventually you do your test, and then you start driving without your instructor, right? The day after you pass your test, do you drive on the motorway?
Nah, that's crazy.
Right.
Yeah.
You get comfortable with your car, the roads, there's still a level of gaining experience that you need.
Yeah.
Once you've realized that, okay, a few scares here and there, maybe I did have a little crash. Now I know what that feels like. I've driven in the rain. I've driven at night. I've driven in summer, autumn, winter, spring. I've seen crazy drivers on the road. A46, shout out. Eventually you get to a point where you're doing your dual carriageways, you're doing your motorways, you're doing long trips, and some people, take it further, become Formula One drivers, or, that's like day trading.
Yeah.
So I think the key thing is just monitor your own progress and don't let a lack of education be an obstacle. A lot of people think that if you're picking individual stocks, you need to open your laptop every day and your account. No, this is another myth. Another myth, if people think that you need to know what you're talking about. No, you just need access to a bunch of people who know what they're talking about. This is the hack. Because you all have your day jobs. You're experts in your day jobs. You also bring something to the table.
Yeah, that's true.
Right? This is how we made a killing off Invisalign. I had a dentist who'd never picked a stock before, and I asked her, what are you seeing in your workplace? We're gonna find some money today. He's like, I've never picked stocks before. I said, this isn't an investing question. This is what are you seeing at your clinic, in your industry? Are you seeing any trends? Are people doing something more than before? Yeah, people are getting their teeth done. What do you mean? Invisalign. I hadn't heard about it back then, 2020. Okay. Who makes Invisalign? Are they a private company? I thought it was a private company.
Yeah.
So I looked it up. There's a company called Align Technology. So you're seeing a trend during lockdown of more and more people compared to previous years really going for this Invisalign thing.
Yeah.
Let me see what the chart is saying. Let me do a financial health check on the company. Let me add it to the stock pickers watch list and let me set a price that's conservative, that's cheap. And if it never hits that price, I'm never going to buy it. If it does hit that price, then we're going to discuss it. So we watch before buying.
Yeah.
We watch, we set a price, we discuss before buying. And by buying, it might just be one person in the group that buys it because they got some capital. I might not buy it.
Yeah.
It's just making sure that that process happens before any decision is made about your money.
Yeah.
This thing did 4x in like 8 months.
I'm not surprised. Yeah.
Quadrupled. S&P 500 is not going to give you this. This is what being in the right rooms can do.
Yeah.
It can give you the opportunity and the option to be able to eavesdrop, check for yourself, have that dialogue. If you're a dentist and all you've ever done is S&P 500, and I tell you that Invisalign is alerting, i.e. it's hit a price level which is very, very low risk and potentially high rewarding on my watch list from my models, and you know the product well,
Yeah.
would you invest?
I mean, yeah.
Without me telling you to invest, just with that knowledge,
Yeah, I would.
would you think, yeah, actually, if I was going to do something other than the S&P 500, this might be the one because it's my industry. I know the product, and you're just telling me it's a good price. Yeah, okay. Let me sell 10% of my S&P 500, split that into a budget, and I'll place a little bit at that price and give it a go. So your starting point often is something that you know.
Yeah.
That also, because there's a lot of financial gurus out there saying, if you're investing in the stock market, buy stocks that you use. You use WhatsApp, buy Meta. You got an iPhone, buy Apple. A load of rubbish. Price, ultimately, is what's going to determine whether you make money or not. Price. It's the most important thing. Price. It's what you pay. Value is what you get. Warren Buffett quote. So if you can get a stock that's a business you know or you use. Add that to a good price. Add a discussion room that you can talk about it before buying. You're on the route to having a very good stocks portfolio.
Yeah.
That's optimal.
Yeah. So I've got a few questions I'm going to ask you about valuing, but just before, so we obviously highlight to people, what would you say obviously are the risks with investing in individual stocks, I guess, from your point of view?
Yeah, so individual stocks are a bit more volatile. So generally, what you want to do when you invest is you want to make profit, but you also want to do so with the minimum headache. And headache in finance and investing is described as volatility, which is standard deviation, variance.
Yeah.
So I want to set myself an objective of growing my savings using the stock market, but keeping the volatility as low as possible.
Yeah.
As possible. There will be volatility, but I want to minimize that volatility. And there's certain things that you can do to minimize volatility. If you only ever buy a stock that's on sale, that's a massively discounted, then more likely than not, your probability that the price goes this way than that way is higher.
Yeah.
So investing is more about not focusing too much on the outcome, but focusing more on the decision.
Okay.
Right? So I don't care whether a stock makes money or loses money. What I care about is that my decision gave me the best possible chance of making money. Of making money. And gave me the lowest possible chance of losing money.
Okay.
And if I focus my decision making around those two metrics, hand on my heart, I know that I took a buy alert or I took profit, and these decisions were being made with those concepts rather than how much I've made or how much I've lost. Investing is a game of good decisions.
Yeah.
And a good decision can lose you money. And a bad decision can make you money.
True. Yeah.
But the key thing is if you constantly keep making good decisions over and over and over again, your portfolio will do what mine did.
Yeah.
So I started with my pension. And it's very, very important for people to realize is if you don't have savings, but you have a pension, you can actually pick stocks or the S&P 500 or both in your pension and start securing your retirement.
Yeah.
And that's how I started. And I was able to 10x my pension. But the most important thing is in doing that, I took people along. So I practice what I preach. The very, very first transaction I ever did in my pension, I screenshotted it, said to people, listen, this is my analysis. This is what I'm thinking. This is where I'm looking to sell. This is how much I'm putting in now. This is how much cash I'm holding back just in case. More time than not, when you buy a stock, it drops.
Yeah.
Right?
Definitely, yeah.
A lot of investors focus so much on trying to pick the perfect price, which means they're good. Trying to pick the perfect company, which means they're a good stock picker. The most important thing is strategy and the sizing of your position.
Yeah.
Because I have picked many a bad stock and made a lot of money from the bad stock because I had a good strategy. So what I was known for at Goldman Sachs, at the hedge fund, like turning underperforming portfolios into profit is like that's my bag. Bring me a portfolio that's all red, where you FOMO'd, and I will have the solution that can get you back on the right path. And that's how I built my name.
Yeah.
So a lot of people I bought this stock, it's down 90%, what should I do? And I know what to do.
Okay.
Right? Doesn't mean everyone is perfect, but the receipts, the testimonials, they speak for themselves. 80-90% of portfolios that are all over the place, I've been able to navigate. Sometimes you need to save a bit more and then average in. Sometimes it's a case of, listen, kill this one, average that one. In the meantime, save up X amount a month for a cash reserve so that we could, knowing how to navigate out of a terrible stocks portfolio is what I'm an expert on. And I actually started Stock Pickers by being a portfolio doctor.
Okay, is that how it started?
Right.
Okay.
The course was just to give people a strategy who had never done it before. But it started with being a portfolio doctor to people on Zoom, via Zoom.
Okay.
Yeah. So I was turning...
I feel like I remember you saying
turning
that in the first
losses into
episode.
winners. Yeah. Turning losses into winners.
Yeah, wow. That's epic. And actually, let's talk about this, right? So valuing a company, right? So you mentioned it. The price is important, the price that you buy at, right? How do people go about thinking about valuing the company and valuing it at a price where, or identifying a good buy price, let's say?
Right. $1 million question. There are like 20 different factors I look at. And there's a phrase, the most important thing.
Yeah.
The most important thing for Apple could be different to the most important thing for Tesla. Could be different to the most important thing for Eventbrite.
Yeah.
Or Pinterest or Snapchat shares. So I'll give you an example of one of the factors. Beta. So beta measures, it's a mathematical equation used to measure the correlation between the S&P 500 and a stock in your portfolio. So some stocks are so correlated with the S&P 500 that if the S&P 500 drops, even if it's a good company, it will drop with it. Apple will drop if the S&P 500 drops on macro news, like the tariffs.
Yeah.
But companies like Snapchat will rise if the S&P 500 rises, even if they're struggling. Snapchat has never made a profit, right? Because it's correlated. So there's a number called beta that will let you know the correlation of an individual company to the S&P 500.
Yeah.
I reckon 95% of stocks investors have never heard of beta, do not use beta in their decision making, right? And are hearing this for the first time. They should be knocking on my door saying, actually, if I learned that off him for free and he explained it in a way that I could understand, I want more, right? Because that's just one factor. So if the beta number is 1 and above, and I put this on the watch list so you can see it, then it means that it's correlated. If beta is close to 0, then it means that no matter that it's got a mind of its own. If beta is negative, it means it does the opposite to the S&P 500.
Okay.
So something like a supermarket, people are going to go to the supermarket before, during, and after the pandemic.
Yeah.
Right? We'll have a beta close to 0. Close to 0.5 or minus 0.1 or something like that. Technology companies will have a beta 1, 2, 3, 4. And the bigger the beta, what it means is it can make more profit, like more profit than the S&P and more losses if the S&P drops. So it's over correlated almost. So you want a portfolio that's diversified by beta.
Okay.
So you've got different beta stocks in your portfolio. So it's beta diversified.
Okay.
One factor. Market cap. How big a company is.
Yeah.
So you've got the big 8 of the S&P 500. Microsoft, Amazon, Nvidia, Apple, Berkshire Hathaway now is there. And you also want a good mix of a bit of the big 8, 1 or 2 of them at the right price, some smaller companies, and maybe 1 penny stock. Now you're diversifying by market cap.
Yeah.
2 factors, 18 to go. Currency. Country the stock operates in. The FTSE 100, I think 70% of the companies in the FTSE 100 actually operate outside of the UK. So they earn their income in dollars. And then they need to convert it back into pounds for them to report earnings.
Yeah.
So if you're investing in UK companies and you don't have a clue what's going on with the pound dollar exchange rate, you're hampered.
Yeah.
Right? The entire UK market is smaller than Apple. The entire FTSE 100 market cap
It's wild to say.
is smaller than Apple, right? And it just kind of, if you go to America, a lot of them don't know what the FTSE 100 is. I had this once on Clubhouse. Someone asked, some American came on and started asking about the FTSE 100. He was asking like it was some emerging market country. But ultimately, the point I'm making is, so I've listed three factors: country of market cap, beta. We can also look at volatility. How volatile is the company? You can look at how close the price is from the 200-day moving average.
Yeah.
You can look at the financial wellness of the company, financial health of the company. You can diversify by financial health.
Yeah.
Every company in your portfolio does not need to be financially in the right place. Because if you have an income and you take a portion of your income to save, now you take a portion of your savings to invest. You invest using your bread and butter, your big eight, your good stocks, your Spartan strategy. You make a profit. How do you make more profit? Well, you take a percentage of your profits and you dance with the penny stocks.
Yeah.
If they go wrong or bankrupt or whatever, you're still up. So that's a process that you put in place, but also exposes you to be able to make some exponential returns. And this is what we're doing through lockdown. So there's a stock called Vero, for example.
Okay.
Venus Concept. Vero is the ticker, VERO. Today is up 135%. Yesterday, on my monthly call, we spoke about it. It's aesthetics. So all these beauty treatments, the machines for all the high level beauty.
Yeah, that's in now as well.
They make the machines.
Oh, wow. That's so interesting.
So yesterday was up 18%. So we started talking about it on I have a monthly call.
Yeah.
I was talking about it to the members. 2 hours later, after market close, something got announced. The stock 150% up. S&P 500 can't do these things.
No, it can't.
But the people that would have got involved in that are people that were already up, whether that's S&P and their stocks portfolio, have taken a bit of their profit and said, I'm going to split that budget and put a little bit into this company. It's on the watch list. There's an alert price. It's very conservative. I've been looking at this stock for 5 years. It's been on the watch list for 5 years. I feel comfortable taking this risk.
Yeah. That's crazy.
This is it. When you're in a room full of other like-minded investors, they'll rub off on you. Even if you weren't a crypto person before, you will say, okay, what is this crypto thing? And I'll tell you. Every 4 years, the amount of crypto you get, the amount of Bitcoin you get rewarded when you mine Bitcoin halves. So let's say 4 years ago, you got 6 Bitcoin. Now you get 3 for mining it. 4 years time, you get 1.5. So it's a supply shock. So every 4 years, Bitcoin pumps. And if you know the halving date and you look at the chart, you'll see that if you buy 1 year before the halving date and you sell 18 months after the halving date, and you've been doing that for the past 5 years, you would have just been buying low, selling high. Yeah. Buying low, selling high. That is the way to invest in crypto for dummies, for newbies. Just Bitcoin. Buy in 2027. Buy in 2023. Buy in 2019. Sell, the selling point, November, December this year.
Okay.
You can hold me to that. You can hold me to that.
You put yourself on record by saying that, you know.
Yeah. You see valuation.
Yeah. Let's talk about that.
What people need to understand, and this is so important, a lot of people get lost in analysis paralysis. There are some textbook theoretical, if you study finance, ways to value a company. Discounted cash flow model, comparative model. But anyone that's an experienced trader or investor will know that if these valuation models did what they said on the tin, we'd all be rich.
Yeah.
They fail. Right? Remember I spoke about factors?
Yeah.
The theoretical valuation is another factor. So there's all these factors that I will think about before. I've got this massive decision-making machine with all these factors. What does valuations via the textbook say this should be at? What do the technical analysis charts say this should be at? What does my view of the macro environment say this should be at?
Yeah.
How is beta playing in this stock? Does it follow beta? Because beta fails sometimes as well. Let me check. Is this one sensitive to beta? Does it obey beta? Is it a large, small, or medium market cap? The smaller the market cap, sometimes it just, beta starts to fail a little bit because it's still a new company. So there's some companies that do very well with their textbook valuation, right? And what you're doing is trying to find a discount to that valuation.
Yeah.
Right? That's your Benjamin Graham long-term investor type of thing to do. And we try our best to factor this into the alert prices as well. But investing in stock prices, prices are irrational. The quicker you learn that, the better. Prices are irrational. They do what they want.
Yeah.
You cannot control price, but you can control process.
Yeah.
The things we can control are how much to put in, what price to buy, what strategy, who we're speaking to before making an investing decision, which stock we actually buy.
Yeah.
The things we can't control, when are we going to make the money? Some stocks might just stay in the same place for a year. Look at Apple over the past 2 years. Like, we can't control when we're going to make, how quickly am I going to make money on this stock? I don't know. But what I do know is here's a good price if you are going to buy that stock. This is a strategy for executing the transaction, how to budget. This is the strategy for idea generation. This is a group you can speak to my friends, my experts. These are the things we can control.
Yeah.
So do the things you can control, make good decisions like we spoke about earlier. And over time, you will, because the point of investing in individual stocks is to outperform the S&P 500.
Yeah.
Right? And I think maybe 99% of investors fail.
Yeah.
Of course, 99% of investors fail. Because how many investors have what we have? How many investors have a shared real-time watch list?
Yeah.
With a group full of over 100 experts?
Not many.
Not few.
Yeah.
These are the things that take luck out of the equation. How many investors have an accountability coach, partner? Not many. I'm telling you, these are the things that will make you more money than picking a good stock. Having someone you're accountable to, having a group you can bounce ideas off, that can stop you making mistakes. It's mistakes that cause those 99% to be in the 99% club. Mistakes.
99% club. People want to be. We all want to be in the 1% club. That's what we're trying to make money, isn't it?
Because of it sounds like 1%. What's 1% of a billion people? 10 million.
You do that, yeah.
Right? That's a lot of people. The 1% club is not as tiny as the percentage number makes it sound.
Yeah.
But these are people who realize that investing is a team game.
Yeah. That's
and it requires strategy.
That's interesting.
I know because, bro, I've been investing for 10 years using this strategy and I've averaged about 30% a year. And then I've been able to coach nurses, mechanics, doctors, gardeners, firefighters to use my strategy. And I'm seeing their returns.
Yeah.
Some of them have better returns than me, albeit they've only been doing it for 2 years,
Yeah.
3 years. And they've tripled their portfolios. They're in the 1% club already.
That's crazy. I was going to ask you something actually about the wrong price. What is the impact if you do buy a stock at the wrong price, right? Because that's obviously quite a big deal as well.
Most of our buy stocks at the wrong... What's the wrong price? Let's define the wrong price.
Yeah.
The wrong price is if you FOMO. The wrong price is if you don't have a strategy. The wrong price is not if you bought at a price and then it drops. That doesn't mean your price was wrong.
Yeah.
If I buy a stock at a discount, a massive discount, and I've got £1,000 to spend on this stock and I only spent 400, I've left myself room to buy some more.
Yeah.
If it drops significantly. Some people buy a stock at 10, buy some at 8, buy some at 6. What are you doing? Stick to S&P 500. What are you doing? That's not how they say. Don't add to a losing position. It's true. Unless you do it my way, where you set a preset budget, a maximum budget for that stock. Most people don't. They buy a stock, it drops, they go to their current account and start digging out money that they never pre-planned for to add to a position. Doing it all wrong.
So it's about discipline and sticking to what you kind of set out, and like you say, not FOMOing and not...
Yeah.
Because buy the dip, of course, yeah, that could be good, but like you're saying, if it's at a detriment to yourself, why are you doing that?
Yeah.
Right?
The wrong price is only if you FOMO at high. Don't buy highs and don't average up. Some people buy a stock and as it's going up, they start buying more. I'm a mathematician. That's going to kill you.
Yeah.
In the long run, you will not outperform the S&P 500, first of all. And in the worst case scenario, you'll make a loss.
Yeah.
Because you're buying more. If you buy something at like 1
Yeah.
and you think it's going to 50 and you buy some more at 10, your average price is 1.8.
Yeah.
Most people don't do that. They'll buy at 1, buy somewhere at 2, buy somewhere at 4, buy somewhere at 5. At this point, your average price is about 4. Whereas if you just bought at 1 and held, you're making 400%, 4x, 5x.
Yeah.
Now you're just making 25%. As you average up, especially if the market stays at that elevated price for a long time, you now have multiple buys, especially DCA, multiple buys at that high price.
Yeah.
So you got more buys at a higher price than you did when the price was cheap. Your average price is therefore within touching distance to the current market price. All it takes is my phone won't stop ringing because of tariffs.
Yeah.
People doing the wrong thing. They've done this and now they're in the red and they don't know what to do.
Yeah.
And I'm saying, okay, this is how you get yourself out of this. It will take time, but this is the strategy to get yourself out of this mess.
Yeah.
Averaging up mathematically, you can do that in the bank. You can't do that in your stocks and shares ISA. And the strategy for managing billions, which I've done, right? I've been responsible for managing a portfolio that's that big. If you use the strategy the banks are using, and a lot of the books, they teach strategies that will help you if you're having a career in asset management.
Yeah.
They're not teaching you the strategy that you use where you only get to buy.
Yeah.
You can't sell what you don't have in your ISA. In the banks, you can sell what you don't have. It's called short selling.
Yeah.
Using derivatives or even physically in the stock loan world. Right? So your strategy has to be different. Your strategy has to allow you to be wrong on price. Like I said to you earlier, bro, more time than not, when you buy a stock, the price drops.
Yeah.
So So you need a strategy that enables you to be able to buy, it drops, and you're still going to make money in the end.
Yeah.
A strategy that's not reliant on you picking a perfect price.
Yeah.
It's the strategy that I sat down and I created myself. And I took what I learned at Goldman Sachs. I took what I learned in my Jewish family office. I took what I learned at a quantitative hedge fund where they build mathematical models to trade the markets. And I took what I learned working in treasury in Barclays. All those different ways of making money, I cherry picked and I applied into one unique strategy.
Yeah.
And then I simplified it and made it bite-sized and easy to use and easy to understand for the individual investor.
Yeah.
And it's a strategy that I use myself. I have been using for 10 years. The Spartan strategy.
Yeah. Yeah.
And what it does is I'm not reliant on picking the perfect price. My first price, I make sure it's at significant enough discount. I use some other things to the model to get that, but conceptually, I don't need to pick a perfect price for my portfolio to perform the way it's performed.
Yeah.
It just needs to be good enough, but my transaction strategy needs to ensure that there's room to buy more if it drops significantly, and the budget already exists to do that. And I've done the different scenarios even before I bought the stock.
Okay. That's interesting. That's interesting. Thanks for taking us through that, because I think it's very important for people to understand that. I think if you're picking stocks, like you say, you should have a strategy. I definitely agree that you have to have a community. I think it's very important. There's so much going on. And if you need it in a certain industry and you don't have it, without a community, you won't have that. So I completely agree. Exactly.
I would never have got into crypto if it wasn't for the group that I created.
Yeah.
But then I put crypto experts in the group.
Yeah.
And first bull run, I didn't want to know. Second bull run, I was looking. 4 years ago, that was the first time and then I made more money in crypto than I've ever made in the stock market. Using less.
Yeah.
That's when I was like, okay, cool. I need to get on top of this so I can, again, feed it back into the beginners in a way that they can understand.
Yeah.
So now the strategy works even better on crypto than it does on stocks because crypto is still a new market. So it obeys all the rules. It obeys all my rules anyway, much better than even the stocks. There's a cycle. We know when the cycle is.
Yeah.
The rest is just budgeting, setting a good alert price. My alert price for Bitcoin was 20,000.
Okay. To buy. Okay.
Ethereum was 1,000.
Yeah. Okay.
Ripple was 0.5. And they've Ripple alone in November did 5x.
I already told you offline. We're gonna do another episode on crypto specifically because we definitely I know people are interested in knowing about that. So we're definitely gonna do that because I think crypto deserves its own kind of conversation because it's becoming more and more important. I wanted to ask you, right? So tariff is it's been a lot's been happening with that. Why do you think this trade war is happening? What's kind of like your reaction to the US?
This is about global power.
Okay.
America knows that it's losing power in the world and China is gaining power. And they need to leverage the position of power to be the big bully. Otherwise, they literally have no choice. If they don't play their hand now while they still got some power, it's going to be curtains. But what most people don't realize is this has happened before. 2018, 2019, 2020, when Trump was in power, he did the same thing. A lot of people don't know this, you see.
Yeah.
Because in those times, they probably weren't even looking at markets. I know it because I was in markets.
Yeah.
And I know how the market reacted. Short-term pain, long-term gain. Eventually, he had to reverse some of the tariffs. And then it was a non-event in the end.
Yeah.
With that knowledge and experience, what do you think we're doing this time round? We've seen it before.
Yeah.
We've seen the back and forth. Last time, China retaliated. We've seen it play out.
Yeah.
It's just happening again. So, skin in the game, experience means we know how to handle it this time.
Yeah.
See it exactly the same as the last time. We've got something we can reference.
Yeah.
It will play out and markets will eventually continue business as usual. And that's all we've seen. This is what we've seen.
Yeah.
The threats, the retaliation, it's played out a bit more than last time because there's a bit of more of a back and forth. But it feels a little bit more like a stronger power tussle than the last time.
Yeah.
And for anyone that doesn't really understand what this means, it's a tax on imports. And a tax on Chinese imports means that if you're going out to buy a Tesla, what's this other one? BYD, a Chinese electric car, you're going to have to pay more.
Yeah.
If you're a business and you are importing parts from China, you're suddenly going to have to pay more, nearly double.
It's crazy.
So businesses get hurt by the tariffs that Trump is setting.
Yeah.
US businesses can get hurt if they're heavily reliant. Apple's already looking for new suppliers or to get more supplies from India. Supplies from India. India, I think, is already one of their suppliers, but they're looking to get
Ramp
more.
it up.
Ramp it up. So it hurts individuals buying Chinese products, and it hurts businesses as well.
That's crazy.
But China also get hurt, which is why they're retaliating. So it is a power tussle. Be interesting to see how it plays out.
Yeah.
But like I said, we're selling S&P 500 at 6,000 in the group and rebuying back at 5,500, 5,000.
That's crazy. Talking about S&P 500 actually, because I did a bit of research.
Did 10% today.
Up, down,
intraday up in one day. That's the annual average in one day.
That's crazy.
In a couple of hours as well.
That's crazy. Because what I was reading just before, it had dropped 17%, and now if you're saying it's up. By the way, people, we obviously don't have our phones. I've got my phone here, but I'm not like checking the S&P 500 what price is at. But last I checked, so today is the Wednesday, the 9th of April, right? I checked maybe about 4 p.m.-ish, and by that time, it had dropped 17%. Actually, maybe it might not have been 4 p.m. It might have been 3. I can't remember the exact time. But I had checked since the February 1st, 2025, it had dropped 17%, that's wild.
Wow.
That's wild for a an index the size of the S&P 500, right? Why are these tariffs? I know you kind of explained like the impact on businesses, but why is it having such a huge impact on the stock market like this?
So not just stock markets. Markets in general do not like uncertainty. I think you remember Liz Truss.
Yeah.
Markets don't like uncertainty. It doesn't matter what it is. And the way the tariffs have come about and the erratic nature in which Donald Trump has announced them has caught everyone off guard.
Yeah.
And when that happens, markets just sell off. It's panic.
Yeah.
Panic selling. What this does is it gives us opportunity to buy, opportunity to get really good prices, whether that's S&P 500, whether that's individual stocks. Nvidia dropped to 90. 90 was my buy price. So when it was at 140, most of my people are selling. That's a sell alert. As a long-term investor, you don't need to be someone that just buys and holds. That's old. That doesn't do it anymore. Not in your ISA. If you're going to outperform the S&P 500, you need to learn how to sell and rebuy back. You're still a long-term investor in Nvidia. If you buy it at 50, you sell it at 140 a couple years later, and then you buy it in the same year back at 90, you're still a long-term investor. Because you're still, in your mind, wanting to hold this stock for a long term.
Yeah.
But you need to stop off at the service station, take your profits, have a meal, and go back in. And if it doesn't fall back down to 90, if it hadn't hit my alert price, Happy days. There's something else on the watch list that's value for money. Nvidia's had its run. $3.5 trillion company.
Yeah.
Is it getting to 7 anytime soon? No.
Probably
There's more
not.
there's other things on the watch list that will double before Nvidia doubles from 3.5 trillion market cap to 7. And this is, you see where they say comparison is the thief of joy? Not in stock markets. Comparison is gold in stock markets. Because you might have an amazing company at an amazing price.
Yeah.
It's not good enough to then go and buy. And we talk about decision making. You find an amazing company at a cheap price. I'm going to tell you to tell me, if you weren't buying this, what would you be buying?
Yeah.
You need to come back with like 10 amazing companies at amazing prices. And then there's another layer of decision making that makes you select.
Yeah.
How do you hire for a job? 1,000 CVs? 500 make it to the first round or the first stage? 300 make it. Eventually, you get to the final round, there's 10. And all of them can do the job at that point.
Yeah.
And then you choose 1 or 2. So why, when it comes to the stock market, do you just see one stock? That's a good price. That's trending. And then you just buy it because it's cheap. Where's your comparison? Where are the other CVs? My watch list is a list of CVs. The alert prices is one stage of the interview process. And then choosing which of the alerts are tailored to yourself and you want to use to build your portfolio is the final stage. And then you pick 1 or 2 to buy. But before you buy, you write out a strategy for it using a budget. Investing is actually very simple as a process.
Yeah.
People complicate it. That doesn't mean making money is easy. But investing is simple. Investing is your process.
Yeah.
And once more and more people realize that it's not going to be that time consuming, you don't need a lot of money to pick stocks. If you're in the right environment with the right strategy, you can actually treat investing like shopping. Investing in the stock market like shopping. Shopping is like, sometimes you window shop. Sometimes you just go out for one item. Sometimes you go Westfield and you actually buy a load of things. But it's not emotionally taxing.
Yeah.
I think a lot of people feel like investing is emotionally taxing. Well, I've made investing feel like shopping. Because when you got a strategy, you're not overthinking things.
Yeah.
You know, you could just go to the watch list, look at what's alerting today, cherry pick 1 or 2 things, have a quick discussion, write an averaging plan, put it in. On your blotter, just set an alert where you might buy a bit more and when you might sell. Get on with your day.
Yeah.
And once you built 5, 6, 7 stocks in your portfolio, now you're just monitoring a portfolio. You're not building a portfolio. Once in a while, every 6 months or a year, you might need to rebalance, which is selling and rebuying back. But once you got your portfolio in full flow, it's even less time.
Yeah.
You just need to check the odd earnings season. Maybe something hits a price to sell, you sell, open your platform, sell, get on with your day.
Yeah. Does your list like also talk about sell alerts as well? You do both. Okay, so you do both sides. The buy and when ideally if it ever hits it, you should.
And my
also
sell
be trying
alerts
to
are like
sell.
conservative sells as well.
Yeah.
So it's like, okay, my sell alert for Meta was 500. The buy alert was 100. It went up to 700.
Yeah.
So some people, they still want to stay in past 500. Just in case it goes to 600, 700 and they're able to get more. But I just want you to know that that's a conservative sell level. So you're aware that anything more than this, the market is just giving you a freebie.
Yeah.
So don't get greedy. So the sell alerts is not, and the buy alerts is not like, oh, go and buy this, go and sell this. It's guide levels.
Okay.
What's a conservative buy? What is a conservative sell price? Right? Otherwise, it's investment advice if I'm just telling you, go and buy this, go and buy this, go and sell. No, it's, you're going to get this anyway. But respect the markets.
Yeah.
These are the only levels that I can vouch for or put my name behind that are cautious enough for a beginner to buy. These are the only levels that I can vouch that you should be selling if you've already bought this stock.
Yeah.
Right? So they're they're like Coach Deb's expert levels for if you want to know you're getting a bit greedy, then this is the level. If you're not bargain hunting enough, this is the level.
Yeah.
One of the biggest skills an investor can have when it comes to picking stocks is you got to be picky. Dragon's Den. How often, you know the show Dragon's Den?
Yeah, of course. It's one of my favorite.
I use this in my course. Bro, how often do you see someone leave with the money?
Not a lot, actually, when you think about it.
Now we're starting to see them every now and again. But do you remember the show back in the day?
Yeah, sometimes you never.
Bro, you got a whole series, and maybe you missed the day when they. But it was like
a big thing.
It felt like a scam. Like these guys never give the money. Why? Yeah. Because the dragons are picky.
Yeah.
As a stocks investor, you need to adopt the persona of the dragons back in the day, where the stock is pitching to you with its leader, its CEO, its price, its customer service, its social media presence. Bro, I check the followers of the stocks before I buy. I'm superficial. I remember when I bought Science in Sport.
Yeah.
Did really well for me. Bruv, I went to the social media. This is a drink here. This is a product. Bro, they had followers on Twitter. They had followers on Instagram.
Innit?
I went to their website. I said, okay, cool. These lot have clout. They must have a decent consumer base because they got followers. These are some of the modern ways that modern investors need to do due diligence. You're not going to get that in a textbook.
Yeah.
You're not going to get that on YouTube. I need to intellectual property that get it on. Add checking how many social media followers a company has before buying it. Where would you have heard that before?
Not a lot of people will talk about that.
It matters because we're in that era now.
It's important as well.
Acquisition value. Once you can eliminate bankruptcy from a stock, Apple ain't going bankrupt. Meta isn't going bankrupt. Once you can eliminate bankruptcy from a stock, the rest is just getting your budgeting right.
Yeah. So obviously going back to tariffs, right, as well, I'm sure a lot of clients have probably reached out to you over the last few weeks, especially this week, which is like, it's kind of going crazy with like retaliation between US and China. What kind of conversations are you having with them to help them manage like their concerns around, should I buy, should I sell? You know, what I do,
nothing changes. If something's alerting and you like the company, you've done the checks, you've done the financial health check, nothing changes. If you're a S&P 500 direct debit person, what I did say to people, listen, at that price of 5,000 and below 5,000, you can put extra. Like you can, if you're in a position where you can do more than you usually do in that month, or you've been sitting on your hands waiting to do your first one, this is deposit levels.
Okay.
And then you can continue your direct debits. I think we'd already been doing a lot of selling. Yeah. My clients were selling Apple at 250. They were selling Nvidia at 150, 140. Okay. They were selling a lot of the big tech they were getting out of.
Okay, Magnificent 7. Yeah.
The only one we didn't sell was Tesla.
Okay.
But we're still up from when we bought. We bought at 150 last April.
Okay.
I got mine. My clients are getting 150. I got mine at 170.
Okay. Why do you not sell Tesla?
I think it's very hard to get a Magnificent 7 into your portfolio because Apple hasn't alerted for like 3 years. So I think I needed that diversification in my portfolio. Yeah. So I just wanted to just see it out. I've sold other things anyway, and I was just hell-bent on having... And Tesla and Meta were the only ones really...
Yeah, that giving any room.
Yeah. So Meta I sold. Yeah. So I said I got to sell one. So I sold Meta and I held on to Tesla.
Yeah. Yeah. So what would be your message to people who are worried about this kind of thing from like your point of view? Like you've seen a lot of turmoil in the stock markets. Now we're seeing turmoil again. It could get better. It could get worse. I don't know what we know. If the retaliation could be crazy. I think right now what we were saying offline, over 100% crazy. That's crazy on tariffs to China, right? Which is mad. So yeah, how do you think about this when you kind of see this kind of turmoil and navigating it?
I'll start rubbing my hands together. Honestly, red equals opportunity, right? If someone had offered you S&P 500 sub 5,000 a month ago, you would have bit their arm off. If someone had offered you Bitcoin at 70, 74, you'd have bit their arm off. So filter out the noise. I'm not saying go buy Bitcoin, because what I do is I don't actually own any Bitcoin. What I do own is the other ones that haven't moved because they're correlated.
Okay.
Yeah. So they will make me more money than if I own Bitcoin.
Okay.
Most of the Bitcoin was getting sold at 100K.
100K.
And then strategically buying stuff like Ethereum and some of the other cryptos that were actually quite good value for money. I'm a value for money investor.
Yeah.
I will buy flowers and sell flowers if the value is good, right?
Yeah. So you're thinking. So you're saying it's kind of like business as usual. Just stick with the strategy that you're kind of.
Yeah.
Don't try and deviate because the stock market.
Yeah. If anything, this is giving you an opportunity.
Yeah.
See people that have been sitting down thinking S&P 500 when, I haven't done it yet. If they took action yesterday, they would be up today by 10% already on an index fund.
That's wild. That is wild. Are there like any specific industries or companies that kind of thrive in these kind of weird markets where it's like very turmoily, everything's going down and
technically defense stocks, but again, there's fury and there's practical.
Yeah.
S&P has thrived, has it not?
Yeah.
Yes, it dipped, but on a recovery basis, it's jumped 10% today.
Yeah.
During a trade war, I think you want to avoid e-commerce companies. If you get the opportunity to buy good top 8 companies on a discount, definitely prioritize that over some of the smaller companies.
Okay.
I think businesses that don't have supply chains in China, there could be a lot of rotation into some of these stocks.
Okay.
As investors, just don't want that risk.
Yeah.
So they could benefit. So one thing you can do even with ChatGPT is you can type in a prompt that says, does Snapchat have any China risk?
Yeah. Does
Apple have a supply chain in China, which we know it does?
Yeah.
But ChatGPT is our friend. It can't replace a community. It can't replace me. It can't replace 2 people having a conversation or a whole group chat having a discussion.
Yeah.
It's your friend. So how can you use ChatGPT in the stock market? Please explain to me how what the business model of Tesla is, like I'm a 10-year-old.
Okay. That's true. It can do that.
I own these 4 cryptos. Can you please explain what they each do, like I'm a 10-year-old? And keep it short. Always remember to say good morning, good evening to ChatGPT. It works harder for you. That's my theory. It rewards politeness. Can you help me do a financial health check for a company? I don't like what it spits out, but it's still better than nothing. I've got a specific way I teach on how to do a financial health check in a way that my clients are very comfortable doing it now. Easy to understand manner.
Yeah.
There's so many. You can use ChatGPT. There's other things as well.
Yeah.
You can ask ChatGPT about crypto, about stocks. as part of your due diligence process.
Yeah.
You can even ask ChatGPT what price it thinks you should buy and what price it thinks you should sell. And what it will do is go around and find the analyst price targets. It'll basically tell you what the textbook, says you should buy and sell at for different analysts have come up with their own price targets and find some sort of average.
Yeah.
It's something you can use as a ballpark. If you see that price aligns with my alert price, it's even makes the alert price even stronger.
Yeah.
It's a confirmation signal. If you see that it's different, at least you know that there's a difference, and you can factor that into your decision making.
Yeah. So you have a lot of like sources of information, which is very, 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 very useful. I had a question for you, right? So obviously a lot of people want to make money from the stock market. So I guess what would you say is a real way to get rich from investing in the stock market? And how did your clients who made $1 million actually do it? Because you talked about your 7-figure clients. So just to know.
Some of them got stock from working in American companies that were paying them in like Coinbase, Goldman Sachs, Morgan Stanley, JP Morgan, some of these tech companies, Apple. But generally, a lot of them have just had good money habits, lived below their means, practiced delayed gratification, right? And very few of them did it by buying some amazing stock, lumping a whole load in, and then the stock did a madness. Actually, it's by saving consistently, placing money into S&P 500, just being consistent with that and scaling up on doing that.
Okay. So through the S&P 500, that's interesting. But making sure that the income that they had.
I mean, stocks as well. But I think like half of that, half of their profits have come from just being consistent, and the other half has come from giving it a go. Okay. Giving things a go.
Wow. That's amazing. And this is what we're saying. It's very possible to do this in investing. Do you think that the market could drop more if more tariffs are introduced?
Yeah, potentially.
Yeah. But it's not something you're worried about.
No. No, not at all.
Okay.
We're long-term investors, so we only care about in the long run.
Yeah.
And in the long run, the market is a voting machine.
Yeah.
Actually, maybe another stock might be at a good price for me to buy. But generally, a drop in the stock market over something like tariffs is not permanent. Yeah. So it's only going to do one thing, and that's provide opportunity.
Yeah. And then are there any industries that you're looking at that you're like, in the future, I'm really lacking that? Everybody's talking about AI. It's like, that's quite obvious.
Everyone's talking about AI. I'm looking at quantum computing.
Yeah, okay.
I had a few clients make 1,000% on some stocks. This is it. S&P can't do this. When you're in the right rooms, we had that discussion on the quant. It was take your pick. And some of them did 10x, some did 5x, some did 3x. A grand turned into 10K.
Yeah, that's wild.
In a week.
Yeah, that's wild.
Crypto stocks.
Okay.
Coinbase.
So Coinbase is, yeah.
So like these stocks give you a way to invest in crypto in your pension because you're investing in the infrastructure around crypto through the stock market. There's a REIT as well, real estate investment trust. This is how you can buy stocks via the property market. So buy property via the stock market. Yeah. I think there's 2 alerting on the watch list right now.
Okay, that you're liking to look at.
Yeah.
Okay.
Then there's another company. I'm not going to say the name. If you want to know the name, you know the name because you're in the group. But this company has a 15% dividend yield, which means you're going to get 15% worth of dividends every year. But on top of that, it is also an alert price. Okay. So you're going to make money in 2 ways. It's dirt cheap. And it's got a high dividend yield, and they're cash rich, financially healthy, and they're not a tech.
For once,
so it's a good diversification in your portfolio as well.
Okay.
Yeah, and they're not a penny stock either.
Okay. Wow.
Healthy, yeah. Yeah.
I'm not allowed to share, but as Debodun said, if you want to know, you have to follow the community.
I own it. Had some clients buying it as well.
Yeah.
The thing about telling people what a good stock to buy is to just go away and buy it.
Yeah.
And then they buy it the wrong way.
Yeah. It's not enough,
And they
is
come
it?
back and tell you a story of how they're down 80%.
Yeah.
And I'm like, well, when it dropped to this level, I put this amount more in. And then when it dropped to that level, I put this amount in. So my average price was there. So then when it then bounced, I made 80%. So I made 80% out of that same stock in the same time you've been in it and I've been in it. Because I'm using the Spartan strategy.
Yeah.
You just bought it and held.
Yeah.
And even if you were to buy more as it was dropping, if you bought the wrong price, you would still have lost money.
Yeah.
The price you buy when you're adding to a losing position matters.
Yeah.
If you're not doing it my way, leave it alone.
Stick to S&P 500.
Stick to S&P 500. Over there. That way.
Thank you so much, bro. It was great to have you on the podcast and, talk all things invested. Like I said, we'll do it like another episode on crypto because I think it deserves its own kind of conversation. Can you share with people, obviously you've mentioned it throughout, but can you share with people how you help people like Stock Pickers Academy if they're something that they're interested in?
Yeah, so generally there's an e-course. The e-course has a strategy taught to you in an easy to understand manner. And it's a strategy that I've been using for 10 years. A bit like learning how to drive. And then there's a subscription to both the watch list and the WhatsApp group, all in one. So you pay a monthly fee and you have access to both. So most people, what they do is they buy the e-course and invest in yourself. And then they subscribe to the mentoring group and watch list at the same time. And yeah, that's the model at the moment.
Yeah.
On Instagram, if you want to be a freebie merchant, then just Stock Pickers Academy on Instagram. Connect with me on LinkedIn as well, Debodun Osekita. And my personal Instagram is coachdebs.spa.
Okay.
So if you're an entrepreneur and you're looking to raise capital, that's another thing I do. I connect angel investors with entrepreneurs. But you've got to be in my group. You've got to be in my network. You can't just benefit from the outside. That's how it works. Because these investors, their capital is limited, man.
Yeah.
And the first
Time limited. Yeah.
Time limited. And the first thing they ask me is, Debs, is this person, are they supporting your work?
Yeah.
Because you're here trying to help someone else build their empire.
Fair enough.
Do they like your posts?
That's fair enough.
Are they part of your group or are they just here trying to use you to get a check?
It's true. We should support each other more. Like, I mean, just generally speaking, you're right. Like, if somebody's going to get value from you, support it. Like, I feel like people are very happy to consume and it's not really giving anything. Okay, maybe buying trainers' hats and clothes and all that has made you a bit happier, but it's not actually giving you value. But to say to support somebody and help them where it's going to help you and benefit you financially, like, I don't know why people struggle with that, to be honest.
Yeah, I mean, like, you don't need to buy my course or join my paid group. There's even a free Telegram group. There's 4,000 people in there. But I feel like if you're going to ask someone for something, ask yourself, what have I given?
Yeah.
What have I supported? Have I posted your post to my story before? Have I told someone to go and follow your page before? Have I introduced someone to Stock Pickers Academy before? Because I've been following you for 5 years, right? And I notice these things. I notice everything. As an entrepreneur, you got to notice everything. You need to know who's who, what everyone does, and who's in your corner, and who's. It's interesting. You get some people that literally they don't miss a post, they don't miss a story. Same like, and do you want a free portfolio doctor? I'm giving the game away. There's some people I'll reach out to and I'll just offer something in kind that's like £300 worth of value because I give back, It's not just Stock Pickers wasn't a business for 6 years.
Yeah.
It was just a free group.
Because you gave the value. You gave the value and then people, are happy to now pay for the value. And that's what it is. I think it's about that value first. And then value is what builds the community. And then, you know, you can kind of do other things after that.
Yeah.
Thank you so much, bro, for your time. I know you got a lot of people pinging you about the S&P 500 today. What's kind of going on? I really appreciate you sharing, like, you know, your experiences, especially from like your, you know, your point of view, like being a trader and even still currently being a trader, from like all the lessons that you kind of learned from Goldman. I think that was quite useful and valuable for us. We really appreciate it. Do you have any final words for the watchers and listeners?
Listen, like, subscribe, comment, support the Savvy Wallet podcast, and please stop waiting and start investing.
Thank you.
Investing is for everyone.
Thank you so much. Thank you. Appreciate you,
Thanks
bro.
for having me on, man.
Thank you so much for tuning into this episode of the podcast, and see you next week's episode.